As Ben Franklin once said, there are only two certainties in life: death and taxes. In this video, we are continuing our discussion of the portion of our book, NextGen Dollars and Sense, that discusses those financial matters that we all encounter on a regular basis. Chapter 16 on taxes offers a variety of fundamental tax concepts because despite the pervasive nature of taxation, for many people, it remains one of the most complex and misunderstood aspects of personal finance. But it's certainly an important one because the average person will pay more than $500,000, or $500,000 in various taxes throughout the course of their lifetime. That's a pretty significant number, and one that would certainly encourage you to make sure you know a little bit about some of the fundamental tax concepts out there. Unfortunately, though, the U.S. tax code consists of about 6,900 pages. Once you throw in tax regulations and official tax guidelines, it balloons to 75,000 pages. So pretty sure we're not going to be able to get through the entire explanation of the tax code in this video. Certainly it is nearly impossible to fully understand all of the various nuances, but a basic appreciation for how your taxes are calculated can certainly help you make better financial decisions. So, Chapter 16 describes the fundamental concepts that impact your income taxes and explains some of the most common deductions, income adjustments, and tax credits available. So, as you might well expect, calculating how much you owe in taxes starts with determining how much you have in total income. So the main categories of income, of course, are things like wages or salaries or tips, interest that you may earn, dividends that you may receive as a result of stock holdings or mutual fund holdings. Retirement income would be another category of income, along with Social Security. Yes, that is included in your income for tax purposes. Capital gains and losses when you sell an asset would also be part of your income, along, of course, with business income and investment property or rental income. So those are sort of the main categories of income. All of those different items combine to represent your total income. So the information typically reported on a variety of forms. It also includes, those forms also include any details on any of the taxes that were withheld and forwarded to the IRS as that particular income item was paid. So there are a few things that aren't considered income, so make sure you don't report them as such. Something you received as a gift, reimbursements and returns of deposits, or life insurance proceeds are some of the main ones that are not reported as income. So after you figured out sort of your total income, the next step in understanding your tax situation is determining your filing status. So there are 5 types of filing statuses available for you to choose, and depending upon your situation, some of them are going to be self-evident or required to be chosen by you. So, for example, single, well, if you're single, then that's going to be the filing status that you would choose. If you're married, you have a choice. You could file jointly or you can file separately. For head of household filing status, that applies to individuals who are unmarried and have supported at least one other individual for more than half of that particular tax year. And then the fifth filing status category is known as qualifying widower with dependent child. Key there is that it has to be a dependent child, along with certainly meeting some other criteria for that particular filing status qualification. Next, we head to a category called income adjustment. So these are things that can be applied to reduce one's total income for tax purposes. So 4 main categories that people typically encounter here. The first would be retirement contributions. You make a contribution to your IRA or something like that. You get to subtract that amount of that contribution from your total income. The amount you paid in student loan interest up to $2,500 can also be subtracted, along with any contribution to a health savings account. And then if you are an educator, you can also subtract up to $300 per year for any out-of-pocket expenses that you made for purchasing school supplies and the like. So after those income adjustments, so we start out with income, and then the income adjustments would subtract or reduce down the total amount of income. Then come your deductions. So deductions are those expenses that taxpayers can subtract from their adjusted gross income to determine their taxable income. So taxpayers get to choose between itemizing their deductions or using the standard deduction. For 2024, the standard deduction is a fixed amount that varies depending upon the taxpayer's status. So for 2024, if your filing status is single, then your standard deduction is $14,600. If you're married filing a joint return, then your standard deduction is $29,200. So more than 90%, I mean, those are relatively high amounts for those deductions. More than 90% of Americans currently use the default sort of standard deduction option. If you want to try and increase your deduction by itemizing your expenses, unfortunately, you'll find the categories of those items to be somewhat limited, which again is why 90% of Americans take the standard deduction. The total amount of your itemized deductions, if you're going to go that route, has to be more than your standard deduction in order to make claiming those itemized deductions worthwhile. The 4 sort of main categories that people encounter when it comes to those itemized deductions are medical expenses, but those are subject to a threshold that you have to get across in order to even be able to use those as a itemized deduction. State and local taxes is another category. Those are limited to a total amount not to exceed $10,000. Mortgage interest that you pay on any mortgage that you might have for a primary or secondary residence. And then lastly, charitable contributions. So those are sort of the 4 main categories of itemized deductions. So once you've gone through that process, then you come to your total tax. So the total tax owed to the government depends on your taxable income. So this amount is calculated using a progressive tax schedule. So that means that tax rates go up as income goes up, and ultimately applies those increasing tax rates to higher income amounts. A couple of concepts here that Chapter 16 of our book, NextGen Dollars and Sense, talks about. First one is your average tax rate, or your effective tax rate is the percentage of your taxable income that you actually paid in taxes. So you would look at the total amount that you paid in taxes and compare that to your income in order to determine your average tax rate. In contrast, your marginal tax rate is the highest tax rate that you paid and only applies to that portion of income earned within that high bracket. The marginal tax rate will always be greater than your average tax rate. So those are some important definitions to know when it relates to calculating your taxes. Tax credits, meanwhile, reduce the total taxes owed and are extremely valuable because they represent dollar-for-dollar reductions in your tax liability. Chapter 16 of our book, NextGen Dollars and Sense, lists a variety of credits that are available, the most popular of which are things like dependent care tax credits that you get if you're putting your child into child care. Energy credits, depending upon what maybe you're doing around the house or if you bought an electric vehicle. Child tax credits are another form of a tax credit if you have certain qualifying children under the age of 17. There's also a couple of different variations of a college tax credits, the American Opportunity Tax Credit, the Lifetime Learning Credit. Those credits and much more details on some of the other credits that are available to you are described in detail in our book, NextGen Dollars and Sense. It's important to note that these tax credits have very particular eligibility requirements. So make sure to research each one thoroughly or consult a professional should you try and claim a particular tax credit. So the taxes that you owe are calculated by subtracting any taxes previously withheld from your income, and then if you've got any of those applicable tax credits, then that also helps to reduce down the amount of that taxes owed. You get a refund, right, if your withholding and credit amounts exceed the total taxes. Otherwise, you have to owe money come April 15th of the following year. So to kind of recap the steps involved in calculating your tax liability, and Chapter 16 of our book has a good little kind of flow chart on this, so which we're going to try and describe next. The calculation itself looks something like this. So if you take total income, subtract income adjustments, that then equals your adjusted gross income. From there, you subtract your deductions. That gets you to your taxable income. Once you get to your taxable income, and you multiply that by the particular tax rates applicable, and then you get to your total tax. From your total tax, then you subtract any taxes that were withheld and any tax credits you are eligible for, and you wind up with whether you owe taxes or whether you're going to get a refund. Chapter 16 also includes a separate discussion on a couple of unique items that have different tax rates that will apply to them, one of which is the taxation of long-term capital gains and qualified dividends. Long-term capital gains are profits from the sale of assets held for more than a year. That's what makes them long-term. The tax rate for long-term capital gains depends on a particular taxpayer's taxable income, but it starts as low as 0%. So if you are in the 12% income tax bracket, which for a married couple is roughly $100,000 of adjusted gross income, give or take, then your tax rate on long-term capital gains and qualified dividend is going to be 0. From there, as your income goes up, as your income tax bracket goes up, capital gains rate and qualified dividend rate increases to 15%, and in the highest income tax bracket, it goes up to 20%. Still less than what the normal income tax rates would be. So definitely some tax savings when you have income that is related to qualified long-term capital gains or qualified dividends. For a dividend to be qualified, it must meet certain requirements involving corporate headquarter location and specified holding periods in order to get those same preferential tax rates. Another unique tax aspect involves selling your home. So certainly some special tax rules that apply to the sale of your primary residence. These rules changed quite dramatically back in 1997 to allow you to avoid paying taxes on the sale of your appreciated primary residence if you meet certain specific residency requirement. Those rules simply state that if you lived in a property as your primary residence for 2 of the preceding 5 years. You can exclude up to $500,000 of gain as a couple, up to $250,000 as a single individual from your taxes. So some pretty valuable tax savings for homeowners when they sell their home. Chapter 16 of our book, NextGen Dollars and Sense, concludes with some ways to use your tax return to improve your overall finances. Far too often, people complete their tax return for the year and never bother to give it a second glance. Throw it in the file cabinet or throw it up on the cloud and then forget about it. But your tax return is an essential summary of your financial situation. It also serves as a guide to the future and forms a basis of being tax efficient, particularly when you're doing retirement income planning. Chapter 16 includes a few of the questions that you should ask yourself as you stare at your tax return. Things like, was your Social Security fully or partially taxable? Did you take advantage of the preferential tax rate for qualified dividends and long-term capital gains? Did you maximize out your retirement savings? Were you charged interest because you didn't pay enough taxes during the year? Understanding all of those various parts of your tax return is a crucial part of improving your finances and making a better financial plan for yourself. For much more details on these various tax concepts that we covered in this video, read Chapter 16 of our book, NextGen Dollars and Sense. You can get your free copy of our book by texting free copy to 407-791-0070. That's 407-791-0070. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, and author of NextGen Dollars and Sense. Thanks for watching this video.